All right, today we're going to tackle a huge idea in investing, one that might just be costing you some serious money. We're talking about reframing market volatility, and not just seeing it as some scary thing to run away from, but as maybe, just maybe, your single greatest opportunity.
You know, this sentence right here, it really gets to the heart of it. For most of us, volatility is basically a scary four-letter word for risk, right? Our gut just screams, get out. But what if that gut feeling is actually wrong? What if volatility isn't the threat, but the resource?
So that leads us right into this big misconception. I mean, we're trained to fear market drops, aren't we? We see red on the screen and we panic. But is that fear based on reality? Is it based on how markets actually behave over the long haul? Or is it just a feeling that's getting in our way?
Because let's be honest, feelings can be super misleading, especially when it comes to money. But the data? Well, the data, that tells a completely different story. And frankly, it's a much more optimistic one. Okay, so let's do this. Let's peel apart that emotional fear from the cold, hard financial facts. We're going to look at what the market has actually done over the years, not what our anxious brains tell us it might do tomorrow.
Check this out, negative 14%. Let that sink in for a second. That's the average dip the S&P 500 has taken inside of any given year every year, going all the way back to 1980. We're not talking about some rare, once-in-a-decade crash. A double-digit drop is a totally normal annual event.
But, and this is the absolute kicker, despite those scary-sounding 14% drops, guess what? The market still finished the majority of those exact same years in the green, with positive returns. I mean, think about that. The market regularly takes a big punch to the gut mid-year and still gets back up to finish stronger. It's incredible.
So these drops, they have a name. We call them drawdowns. And the big takeaway here is that they are not a bug, they're not a mistake, they are a feature of the market. It's just part of the deal. And once you really, truly accept that, everything starts to change.
So if these drops are just a normal part of the ride, then the event itself is kind of neutral, right? It just is. The real game changer is how you, as an investor, interpret it. And that interpretation, well, that sends you down one of two very, very different paths.
Okay, path number one, the passive investor. You see a drawdown and your only goal is to survive. You're thinking, okay, batten down the hatches, I just have to endure this. But then there's path number two, the active investor. You see the exact same drop, but instead of just something to endure, you see it as a signal, a potential opportunity to act.
So the big question is, how do you actually do that? How do you flip the script and turn volatility from a threat into a tool? Well, it's not about relying on gut feelings, and it's definitely not about making wild, risky guesses. It's about having a structured, evidence-based game plan.
And I really want to be crystal clear on this. This is not about trying to predict the future. Nobody, and I mean nobody, has a crystal ball that can perfectly time the market bottom. The whole idea here is simply to observe what the market is actually doing right now and then responding to it with discipline.
Okay, so this disciplined response, we can break it down into a pretty simple four-step process. First up, step one, you identify weakening trends. You watch the price action. You know, when a market that's been chugging along, making higher highs, suddenly starts to sputter, that's your early signal. Then, step two, you act on that evidence and reduce your exposure. This isn't a panicked, sell everything moment. It's a calm, strategic move to protect your capital. Next, step three, and this one's tough, it takes patience. You confirm the trend is stabilizing. You don't try to be a hero and catch the falling knife. You wait for the market to prove to you it's found its footing. And only then, once you have that proof, do you move to step four. You re-engage. You start increasing your exposure again, not based on a gut feeling, but on the hard evidence the market just handed you.
Now look, let's be real for a second. This approach isn't some magic set-it-and-forget-it kind of deal. It absolutely requires a few things from you. It requires discipline, to actually stick to your rules when things get scary. It requires patience, to wait for those clear signals. It requires a structured framework, so you're not just winging it. And yeah, it requires your time and attention.
But when you put it all together, that data-driven perspective and a disciplined process, something really powerful starts to happen. That market turbulence, it stops feeling like this terrifying storm that you're just caught in. Instead, it starts to feel more like wind in your sails, a force you can actually use.
So why bother with all this effort, right? What's the payoff? Well, it's pretty simple actually. Over time, by systematically dialing down risk when things look weak and then confidently re-engaging when they look strong, this whole process can materially improve your outcomes. We're talking about potentially boosting your long-term returns in a big way.
And this really brings us full circle to that ultimate transformation, volatility. That thing we've all been taught to fear and avoid our entire investing lives. It actually becomes a resource. It's the very thing that creates the discounts, the entry points, the opportunities that a disciplined strategy can thrive on. It's not the enemy anymore.
So I'll leave you with this one big question to chew on. Take a hard look at your own portfolio, your own mindset. Is it built just to endure volatility? Just to survive the storm? Or is it built to use it? To harness that inevitable turbulence as the powerful resource it can actually be? You know, the answer to that question, it could change everything for you.